Welcome to Wealthy Behavior, talking money and wealth with Heritage Financial, the podcast that digs into the topics, strategies, and behaviors that help busy and successful people build and protect their personal wealth. I'm your host, Sammy Azzouz, the president and CEO of Heritage Financial, a Boston-based wealth management firm working with high net worth families across the country for longer than 25 years. Now let's talk about the wealthy behaviors that are key to a rich life. Welcome to the February investment edition of the Wealthy Behavior Podcast, where I talk to our Chief Investment Officer, Bob Weisse, about what's going on in the market and investment world you need to know right now. Bob, how's it going?
Going well, Sammy. January was a good month. Maybe we can start there.
Yeah, absolutely.
So just looking at market returns, index returns in the month of January, I'll just read off a few major indices. The S&P 500, so U.S. large cap stocks were up 2.8%. Russell 2000 U.S. small cap stocks up 2.6%. So very similar. Foreign developed markets, so it's the MSCI EFA was up 5.3%. So some nice outperformance from developed international equities. And emerging market equities, the MSCI Emerging Market Index was up 1.8%. So all around for equities, a solid month. Good start to the year. And then bonds also performed well. The Bloomberg U.S. Aggregate Bond Index was up 0.5% for the month. So nice return there. Commodities were up. Commodities were up 4%. Bloomberg Commodity Index and REITs, the Nareit All Equity REIT Index was up 1%. So solid month for investors. Good start to the year. And we had a sell-off in I think it was more the second half of December. So the year ended on a down note. We didn't get our typical Santa Claus rally, so to speak. But we had a nice bounce back in January. So things are looking good.
Great. Bob, I wanted to ask you about bonds as a starting point because we've shared in our outlook, both in our written content and our webinar, and also through this podcast, that there's an attractiveness to fixed income now because yields are higher, maybe rates are stabilizing. And the question that I've been getting a little bit more frequently is if bond yields are decent, but bond prices can move, given how interest rates perform, why aren't you just better off kind of buying and holding individual bonds versus how we approach it, which is through commingled vehicles like a mutual fund or an ETF? And I know how to answer that question, I think, but I'd really love your perspective on it.
Yeah, it's a good question. A little tough one to succinctly answer, not get too technical, so I'll do my best. But if you limit, the first question is what type of bonds are you owning? If you limit the scope of your bonds to U.S. Treasury bonds, then buying individual bonds, individual treasuries, or a treasury bond fund, it's pretty similar. Either way, you own a basket of treasuries. If you're taking credit risk, meaning not buying treasuries and buying, say, corporate bonds or securitized bonds or municipal bonds, really anything other than treasuries, now you're taking credit risk, which is the risk of default. And that's where diversification is your friend. If you're buying individual, say, corporate bonds, or what I said, securitized municipal bonds, if you're buying them individually, we'll frequently see people who might buy 20 bonds, 30 bonds, 10 bonds, up to 50 bonds, something like that, but they're not buying 500. And if you have 20 bonds and one goes under, one goes bankrupt, that's a 5% loss. You just lost 5% of your capital. Whereas in a bond fund, you'll see hundreds or thousands of holdings, and therefore you're able to get diversification. And if there are defaults in the portfolio, you have enough holdings to reduce the risk. So diversification is one reason. And a second, it is liquidity. We do prefer mutual funds. Maybe even a question on the question is some people ask us also ETFs or mutual funds, which vehicle do we prefer? We do tend to prefer mutual funds for bonds because mutual funds will always trade at net asset value. So you trade it during the day, you sell it, and at 4 o'clock, whatever the value of the assets in the fund are, that's what the trade executes at. Whereas if you're trading individual bonds, so this gets to another drawback of bonds, specifically municipal bonds, you're dealing with a bid-ask spread, and the bid-ask spreads can be pretty wide. And bond trades today are actually still typically done over the phone. You can do them online too, but the pricing is just nowhere near as efficient as stocks. So with stocks, you typically see a 1 penny bid-ask spread, the difference between what someone's willing to pay and what someone's willing to sell. For bonds, it can be a 2 or 3% or even more. So if you're trading bonds rather than holding it to maturity, and I know people don't get into bonds thinking they're gonna. I'm not talking day trading, but I'm saying you buy it and 3 years from now you need to buy a car and you want liquidity. And if you go to sell a bond, you might lose 2 to 3% on the sale. Whereas if you sell a bond fund, you might be looking at a $7 ticket charge, and that's it. So liquidity is another reason. And then maybe a third is we are able to get exposure to harder to access parts of the market through bond funds like securitized credit. So think of asset-backed securities like auto loans, mortgage-backed securities like non-agency, like not Fannie Mae or Ginnie Mae, non-agency mortgage-backed securities where you hire professional money managers and they navigate those markets and they pick and choose their spots. And those bonds typically come with higher yields than treasuries. So you're getting a yield premium there. That's tried to be succinct, but my long-winded way of sorry of saying that our belief is through bond funds you will get a higher return. And I think the premise of the question came from interest rate risk and the idea that, oh, well, if I buy a treasury bond and say it's a 5-year bond and interest rates go up, I'm not going to lose money because it's going to mature at par. But if you look at your statement, it will be marked down. If interest rates go up, the price will go down. You will see a decline in value just as you'd see a decline in value if you owned a 5-year treasury mutual fund or ETF. And then as those bonds approach their maturity date, the price will appreciate back to par. So there is some mental accounting, but I don't think it's very real or a reason to invest that way.
That's a great overview, Bob. And when you invest in fixed income with your team, you're looking at two things that you mentioned, credit risk and interest rate risk. How much credit risk do we want to take? How much interest rate risk do we want to take? And that's a function of the environment that we're in. So I guess my question is there a fourth reason? And that is so that you can change your strategy and where you want to invest in fixed income uh, quicker and more efficiently by just swapping one mutual fund for another versus, trading 30, bonds in either direction?
Yeah, I probably didn't hit the liquidity point hard enough. Liquidity that comes with mutual funds and ETFs are still fairly liquid, much more liquid than individual bonds. So by having vehicles like an ETF or a mutual fund, it allows you to rebalance the portfolio, reallocate, raise cash, whatever it may be. If we were to buy individual bonds, with the exception of treasuries, the treasury market, even at the individual security level, is fairly liquid. But as you get into, especially munis, like I said, but as you get into individual bonds, like corporate bonds, the liquidity is to the point where it's not worth trading. You should really buy those going in with the plan to hold them to maturity. And that just to us to some extent defeats the purpose because for many clients, when you think about a portfolio, if you're just thinking a simple world of stocks and bonds, well, my stocks, that's my long-term money. My bonds, that's more my liquidity, my shorter-term money, almost an emergency fund of sorts. If I need to spend, I can draw from the bonds. And if you're buying individual bonds, that's not necessarily true. With bond funds, we can turn that into cash in a business day and not take a hit on a bid-ask spread, just execute at NAV if it's a mutual fund. So liquidity is a big reason to own mutual funds.
Yeah, for a variety of reasons. Thanks for adding that color. And I know you've been getting a fair amount of questions on, is it international equities and just generally existentially why they belong in a portfolio, or is it more sophisticated than that?
There has been what I would call foreign fatigue a little bit. I've had some conversations with clients on that topic, but I was just thinking about what to talk about today, and this podcast is called Wealthy Behavior, and we haven't talked about behavior too much from an investment standpoint. And typically, when I'm in client meetings, I see many clients like to look at the statement that might have 20 or so holdings and try and understand which positions performing the worst. And the natural behavior is to identify the laggard, and then the client intuition is to sell that position. Well, this one's obviously broken, so can we sell this one? And by the way, they might want to buy the one that's doing the best. And I've had a lot of conversations of that nature over time. And in the spirit of talking about wealthy behavior, I thought just a high level discussion on why that approach is not a successful one would be good. So there's a few points just to review. One is just talking about market efficiency. And we do believe that the markets are generally efficient. There's a lot of professionals out there trying to outperform. Many of them don't. And you just need to be aware of that when you go in, that markets are very competitive. And I'm talking about public markets. So think about public stocks, whether they're US or foreign, bonds. There's a lot of professional investors managing money, and it is very competitive. So we think a good starting point for people to think about markets is that the price is right, that the price is fair, and to go in and say that one market is mispriced and you should act on that is probably not a good place to start. Then the second point is what's called the behavioral gap or behavior gap. Morningstar does a study. I think they've been doing it each year now. In 2024, they called it Mind the Gap. And they said investors lose out on about 15% of their return, which that might be a little misleading because it's 1.1%. And I think 1.1% of divided by the total return equals 15%. So it is 15%, but it's not losing the total return of 15%. But the way they look at it is they're comparing the return that a fund reports through what's called a time-weighted return, so just the percentage increase over time. So the return that investors in the fund actually realize, which is a dollar return, and this gap of 1.1% is the underperformance, and what you see, how you get there, because people are probably scratching their heads listening, saying, well, why don't investors get the same return that the fund gets? What's going on here? What happens with open-end funds is people can buy and sell them any day the market's open. And after the fund does well, what happens? People buy. After it does poorly, what happens? Some people sell on the net. And when the funds have drawdowns and are underperforming, the asset base shrinks. Then it does really well on a small asset base. And now it has a good track record and the asset base grows. So investors are constantly rotating, basically chasing winners, going after yesterday's winner. And what happens with markets, that the winners typically become losers and the losers become winners. And it's a terrible cycle that causes investors to underperform. So mind the gap as a second point. And then just the third point is what is in a stock price. And I'd say the most common way, or the way we're taught to value companies, is using a discounted cash flow methodology, where you basically take all the cash flow that a company is expected to produce over its life, and you discount it at a discount rate to get the net present value of that cash flow. People say markets are a discounting mechanism, so it's trying to package everything a company is going to do financially into a current value today. So the higher the price is, so if you look at, say, Nvidia, that got up to about $3.5 trillion being its market capitalization, that is discounting a lot about the future. It's setting expectations to be very high about the future. And if you pause and look at Nvidia as an example, to go from, say, 50 billion of valuation to 3.5 trillion of valuation, the rear view return looks phenomenal. That's a 70x return. And investors who are inclined to chase performance would say, wow, we should own that. But what's happening is the market is discounting that value to 3.5 trillion. So it's expecting very good things about the future. And as expectations go up and up and up, the ability to disappoint markets, I would say, also increases. And we saw that, I think it was either last week or the week before, with the news about China and their progress in AI. And ironically, their AI program even uses NVIDIA chips, just I guess a cheaper version of them. And NVIDIA went down double-digit percentages in a day. I think it was around 17% decline in a day. And I would attribute that a little bit to how much the market is expecting about the future, all the good things, that even really a sliver of bad news can have a more material impact. So just wrapping that up, what I'd encourage our listeners to do is not chase performance. There's a saying, if you're comfortable with everything you own, you're not diversified. That was from Peter Bernstein, consultant, and that gets to a diversified portfolio should have different market exposures, different risk factors, different investment styles, and they all shouldn't be working at the same time. So that's what diversification is. And that's one quote to share. And then The second one, Sammy, I know you're a Warren Buffett fan. Be greedy when others are fearful, and fearful when others are greedy. Like that's a good mantra as well. That when you look at markets, what's the consensus doing? What do people want to be buying? And then what do people not want to be buying? What's not popular? And typically a more of a contrarian approach is good. And that's not looking at the worst line item on your statement and trying to sell that and then buying the hot thing. So just a reminder on behavioral finance, how markets work. And I do think with investing, humility is important too. So don't think it's as simple as what's done well lately is going to keep doing well and what's lagged is just going to lag. Markets do mean revert over time. Valuations do matter, and discipline's important.
Great overview, Bob. That was some passion coming through there in terms of a lengthy explanation as to why you feel the way that you do, which is tremendous. It's very insightful and consistent with the theme of the podcast. We've been getting questions on tariffs. I know it's on people's minds. I know you have no idea what tariff policy is actually going to be enacted because it is changing. The policies in and of themselves are volatile. We've talked in prior podcasts that there will likely be some policy uncertainty in this administration, particularly until we have midterms and maybe there's a little bit of a potential balancing or change. But policy uncertainty could lead to market volatility. And so it's a long-winded way of me asking you, how do you think about tariffs? And when a client or a prospective client or a friend asks you, we know there's going to be some more volatility related around this. Why aren't we doing more to protect against that in a portfolio?
Yeah, so starting with the last question, more volatility. We have been talking about a theme of increasing fixed income. So I do think that given where stock valuations are now, which is on the higher end, especially in the US, and where bond valuations are now, which yields are up on the higher end of where we've seen for the last 15 years. But when I say that, that's a good thing for bond valuations with yields being higher. It is an environment that I would encourage people to lean into bonds a little bit more than they have been. So that is actually really being more consistent with, yeah, it is time to be a little more defensive than you would be in, say, a more neutral environment because the bond market's paying you. So that is one. But as far as
Bob,
forecasting,
just interrupt you real quick. That's more about valuations in equities than policy uncertainty with tariffs, right? It just
it,
so happens that they're
yes,
lining up at the same time.
that is true. Yes, that is more around valuations. But it is a good time, I would say, to lean more towards fixed income. So it's not a result of tariffs, you're right.
So
Um,
let's hypothesize and say that, valuations are fair. You know, if you take out valuations and somebody said, why aren't you doing more to protect my portfolio from the policy uncertainty of tariffs? What would you answer?
Yep. Politics typically are something that I think as a broad category should not play into an investment approach or one's thinking. And we saw it just over the weekend how tariffs were announced on Mexico and Canada, I think it was Sunday. And then by Monday, the market's crashing. And then by Monday afternoon, they're not happening and a deal was struck. And it just to invest around that with what happened in 24 hours is just, I don't think something that really anyone can navigate well. So, there's a saying, focus on what you can control, and you cannot control tariff threats or policy. That's one point. And a second is even if you did have the playbook, like you had the newspaper from 4 years from now, and I could tell you from a tariff standpoint what would happen. Even then, it's not always obvious who's going to win and lose at the company level or region level. One stat that I think we might be putting out a chart on because we've been getting more questions on this is in Trump's first term as president. If you recall back to the debates and the rhetoric that he was using to get elected, he was not a fan of China. It was like the US versus China, make America great again. And China's been doing all these things to eat our lunch. And guess what? In his first term, the Chinese stock market did better than the US stock market. And then it reversed when Biden was in office. So like you never would have expected that outcome. So it's not that simple. And did China outperform the US stock market because Trump was in office? I would argue no. It had really nothing to do with that. It's just news covers politicians and people read that and that's what they hear and see. But markets are way more complicated than that. And even if you get into tariffs and you drill into it, uh, how do foreign tariffs impact US companies? So you take Apple, for example, they're manufacturing iPhones in Asia. And, I know Tim Cook's they're trying to negotiate deals with Trump so they don't get caught up in it, but it very well could negatively impact one of America's largest companies as he's trying to bring manufacturing onshore, but I don't think Apple will be manufacturing iPhones in California. So it's a very complicated picture, and there's a lot going on in markets beyond policies coming out of the executive office. So you can read about it to be informed, but I would not make changes to your portfolio based on what you think may or may not be happening with tariffs.
Great overview. What else is on your mind, Bob, as you sit down with your team and you're looking at client portfolios and some of the changes that we've made recently? And you said this year is off to a good start.
Not much we haven't been talking about. I mean, the inflation watch, kind of the delicate balance that the Fed's dealing with right now, with getting inflation down, but also not sending us into recession. We did have a JOLTS report come out within the last week, so job opening, labor turnover survey, and we're now below the level of we were in like 2018, 2019 before COVID of job openings to unemployed people. So the balance in the labor market has gone from too many job openings to workers to now we're starting to break through to the other side of that where there's actually getting closer to less than average amount of unemployed people to jobs. So that could point to a slowdown, but it's in balance right now, I would say. So just watching that Fed policy, increasing bonds, reallocating portfolios. There's a lot to keep us busy.
There is a lot, and that reminds me, we talked so much about the Fed and inflation watch for a while, and now it seems like we might be on tariff watch. And, regardless, the market chugs along. It's going to do
Market
what it
chucks.
does. Most of the time, it'll be up. There'll be some setbacks. You ride through the setbacks, and you take advantage of the long-term trend. And it's important to keep people informed about some of those things that can be shorter-term themes, but they come and go, and the market still does what it's going to do, and mostly what it does is positive for people who stay invested.
Well said, Sammy.
Wealthy behavior, Bob. You
That's right.
motivated me with your interlude there on foreign stocks. So I appreciate the time as always. I know our listeners enjoy getting inside the head of a CIO. So thank you for your time.
Thanks, Sammy.
Thank you for listening to Wealthy Behavior. If you found the conversation useful, please leave a review wherever you listen to your podcasts and share this episode so those around you can live a rich life too. We appreciate your feedback and questions. Please email us at wealthybehavior@heritagefinancial.net. For more insights, subscribe to our weekly blog at heritagefinancial.net and follow us on Facebook, Twitter, and LinkedIn. Check out my personal finance blog at thebostonadvisor.com. Wealthy Behavior is produced by Kristen Kastner and Michelle Kakanis.
This educational podcast is brought to you by Heritage Financial Services, LLC, located in the greater Boston area. The views and opinions expressed in this podcast are that of the speaker, are subject to change, and do not constitute investment advice or a recommendation regarding any specific product or security. There is no guarantee that any investment or strategy discussed will be successful or will achieve any particular level of results. Investing involves risks, including the potential loss of principal. There has not been and will not be any compensation exchanged between Heritage Financial Services and podcast guests or recommended resources.